Good morning, everyone. Excuse me. Welcome to our Wednesday morning trading room. Allow me to get the screen share opened up. All right, so I never did get that larger decline that I was looking for yesterday. In fact, the market spent much of yesterday in a slow upward / sideways grind. The overnight was a little bit neutral and quiet as well. You can see right here, very, very quiet overnight session. And we are starting today pretty much where we left off yesterday. So the eagle here, a little bit more with a bearish flavor to it right now. We're only a minute or two into the session, so we'll give them a moment here to get their bearings. Looking like we may get a little bit of a bullish pushback. Here the hawk trying to get bullish, as is the falcon. We've got a trend line change. We're back into the hard edge now on the raptor and the eagle. So both those tools still a little bit more in a bearish state. Would not be opposed to the idea of a buy. Here is your first micro macro cross now in the hawk, and because it's a possible reversal, we would be looking at a test of the extreme, right? So the market should come down here, try to retest the lows before it tries to rally higher. That's why, even though the first micro macro cross printed here, I've just placed my order above that zone. In case it doesn't materialize. So now we've got a 4-arrow consolidation. This is going to be the last kick at the cat, so to speak, for the buyers. If they can't rally the market from here, well, then there's a very good chance the downtrend will resume. And of course, nothing says you can't take that signal a little bit earlier, right? You can of course take the signal down here. This is where the 4-arrow consolidation actually printed. Come on, let's get that break even out of the way. This, by the way, now another first micro macro crossover signal. And just looking here for maybe a short-term move. Here on the Raptor, we've also got a number 2 signal. This right here, a number 2 signal after the number 3. This number 2 signal did not print, probably because it took a little bit longer to develop than the programming parameters allowed for. But we still have something resembling a trend. We have the test of the extreme, and then we have the reverse. Those are the key components for a number 2 signal. Back into the hard edge though, and that always a difficult spot for the market because if the market's going to resume the trend, it's probably going to do it here from the hard edge. Okay, I can probably roll my stops up a little bit. I'll probably bring them in right here somewhere. Like I said, this is a little bit of a risky trade because it is very early still for the market. And you can see we've got a lot of yellow bars clustering here, more or less the same price level. That's all an indication that the market is not really committed just yet. Yeah, the sellers are still very strong here. You know what? I may give it just a couple more ticks here. We'll stay on the other side of 68.28. The danger is the market's going to fudge this support area by a tick or two and then reverse and try to head higher. So I don't want to get caught prematurely. If the market is truly heading lower, okay, that's one thing. Go ahead, stop me out. But if it's only thinking about it, then I don't want to get tagged right away. Well, it certainly is still, well, sideways to down. All right, hang on here a second. So that seems to be the theme for me these last few mornings as I dig myself a little bit of a hole. And I gotta spend some time digging my way back out. Doggone it anyway. All right. So the downtrend seemingly intact. Let's see where the lows from yesterday's range were. And it looks like we're kind of zeroing in on that neighborhood around the 68. It looks like they got as low as 68.10. A little bit more going on here around 68.15. Okay, got a pullback going on yet again. So we're got a little bit of a hiccup here now. A macro pullback signal here in the hawk. Falcon trying to change direction, working a possible trend change signal there. Making our way back now to the hard edge of the trading band. If we are going to continue in this sideways pattern, it makes sense that we would see a reaction around 68.15. Okay, we now got a red bar buy going on here in the hawk. And here comes the Raptor with yet another number 2 signal after a number 3 signal. So these number 2 signals after a number 3 tend to be a little bit more reliable. The better entry, I suppose, would be here. That is giving up a little bit on the entry side, but it does kind of help keep you on the right side of the market. If we do get a second push opportunity, which it looks like we have now, you could probably get by entering a little bit tighter, just above the high of this particular signal bar. This is I seem to be stuck in counter trend mode the last couple of days. The problem with a counter trend signal, of course, is that you kind of block yourself from taking the with trend signal. I don't know, sometimes you just get in a mindset and it's hard to break it. Trading a very psychological business. You know, obviously it doesn't require many physical attributes. You don't have to be especially strong or anything like that. Strong-willed, I suppose. Scott's asking about the red bar buy on the hawk. Actually, you know what, Scott? I'll show you here on the cheat sheet. It'll be a little clearer. Bear with me a moment. All right, so here is your hawk cheat sheet. And the red bar buy is the signal that tends to develop near the end of a trend. So you need to have something resembling a trend, even if it's just a little bit of a trend. The market pulls back, all of a sudden the bar colors start to change. You get a red bar with a buy signal. This is kind of the last kick at the cat for the buyers. And it's a signal that you can buy with trend, or you can look to short below, and you can look to sell it on a failure. And you can see sometimes you get some pretty decent follow through on that. Or you can simply use the red bar buy or its bearish counterpart, the green bar sell, as a signal that the current trend might be ending. It tends to be a very weak signal, though. It's not one that I place a great deal of confidence in. You'll also find that the first red bar buy tends to work out better with trend, and the second red bar buy, if you get one, tends to work better counter trend. Well, we keep pressing. Now we're really back down near the thick of it, near the 68.15 range. You can see we even have a primary support line printing here at 68.16 3/4. And we're getting this candy striping going on here in the Raptor. A lot of number 2 signals printing. So we got more bullishness creeping into the market. If that's actually going to result in, did they slip me? Look at that. What's going on with the slippage here today and yesterday? Oh, you know what? Let's see if we get a reverse out of this. I need to see if I can recover part of that earlier trade I did. There we go. So I'm going to roll my break even above this swing high here at 68.30. And I set my profit target back here near the median line around 68.40. It may or may not get that high. This little swing right here around the 68, 26, 27 area. That's a pretty influential zone because, of course, it is the hard edge of the trading band. Once we get above there, I might get a little bit of follow through. Maybe kind of, sort of. And I think I'll set I won't be quite as ambitious with this profit target. Maybe I'll look at 68.35. Okay, so back into the hard edge. $68.30 is the value to beat now. Wow, we are hung up. At 68.30. A little bit of a test of the extreme now. Really sideways market. All right, so now we've got a little bit of a test of the extreme here. And we're going to make another run at 68.30. If we get over that hurdle this time, we should get some follow through. David's asking, what does the Q1 beside the entry price mean? That's my quantity, David. So, for instance, here, if I were trading the Hawk and I have my risk set, say, at 2%, and I'm looking at taking this first micro macro cross signal, and I choose to set up the trade this way, based on 2% of my capital, I could trade 3 contracts. Now, the beauty of the trade manager is that it controls your risk for you. So watch what happens. If I set my stops really, really tight, oh, look, the risk amount remains approximately the same, except now I'm trading 8 contracts. So what if I put my stop way down here below these lows? Oh, okay, a little bit of a rounding thing going on, but let's do it like this. So I'm going to set my stop way down here. Oh, look, the risk amount remains the same, but the quantity changes to accommodate that. So then the big question becomes, which trade has the greater likelihood of success? The trade where I placed my stops right here, the trade where I placed my stops right here, or the trade where I placed my stops right here? Well, intuitively, it should make sense that the trade with the biggest stop has got the greatest likelihood of working out, because the one with the tight stop is more likely to get tagged, right? Especially in a sideways market like this. Even this stop right here is a little bit touch and go. So if the trade's going to cost me $400, because that's what Trade Manager is set at, why don't I leave a more reasonable stop? And that's the whole logic behind trading. So you can see if I had my initial stop here, well, I would have been tagged already and I would be out my $400. Now, the upshot for all this, of course, is that when you're risking more contracts, you have the potential to make more money as well. Stop it. So going back to this trade, if I set up my trade like this and I have my $50 target, well, I have the potential to make $400. If I set my trade like this, because I'm trading 3 contracts, I have the potential to make $150. And if I set up my trade like this, I have the potential to make $50. So it seems very lopsided to most people that why would I risk nearly $400 and only make $50? Well, again, it's the probabilities. A stop loss is not a loss unless it gets hit. This is something that most people never wrap their heads around. It is not a loss unless it gets hit. They get so focused on the profit side, they get so scared about losing money that they strangle their trades. They place their stops overly tight without taking the market context into consideration. So you look at the market context here, you look at the left side of your chart, what do you see? Well, you see a market that is stuck in a sideways range, right? So when that happens, a lot of people panic and they set their trade overly tight. What happens? The market comes up and it tags you out. Okay, well now you're out your $400. Never mind, you had a chance to make 400. The market continues lower. Oh, you get tagged again. So at least with the deeper stop, even though it looks like it's going to get hit as well, you have a higher probability of success. You have a higher probability that the trade is going to work out. And usually with the deep stop, just because I start with a deep stop like this, doesn't mean I need to leave my stop there all the time. So for instance here, when the market tried to recover the trend, tried to recover it again, at that point I may have said, all right, let's bring the stops up a little bit. Maybe we'll bring them up here. The market reverses, taps me out. Okay, I took a loss. It wasn't a $400 loss. It was probably, looks like, about 200. So if Trade Manager says I can afford $400 and that's 2% of my capital, if I get tagged at 200, that's only 1% of my trading capital. You're not going to go broke losing 1% of your capital. You're going to blow up your account routinely losing 8, 10, 15% of your capital. But if you can control your risk exposure, that makes a huge difference to your overall success. Let's see if I can find it here. We have this tool called the Money Expert, and this is you can go to indicatorwarehouse.com/money expert. Here, I'll actually put it in the window for everybody. You can play with this afterwards. And what it does is it tries to drive home the importance of money management. So in an effort to be conservative, most people will trade onesies, and here you can see an equity curve. Good old Joe was doing okay trading single lots. He started with 10,000, and after 100 trades, he's up to just over, about 15,500. So a really good run. But how would he have done had he traded multiples? Well, according to the math, trade for trade, he could have actually taken that $5,500 gain and turned it into a $40,000 profit. How? Well, by controlling his risk. So let's say you have a $10,000 account. You're only profitable 50% of the time. Half your trades are losers. The other half are winners. So it's not like you're running, some sort of super high-tech trade algorithm. You're only running a 50-50 system, but you're controlling your risk at 2% of your exposure. How does that work out? Okay, well, this is actually a very realistic example. This example, you can see that you and Joe did the same. So you started with 10,000, you ended with a little over 12.5. There was absolutely no difference between your results and Joe's results. So there was no advantage to using position sizing, no disadvantage. This one I don't like. That's mathematically, the computer is generating these results. So mathematically, sure, it's possible, but realistically, probably not. Okay, this is a more realistic equity curve. It looks like you and Joe had a pretty good run. Now remember, the way this works is when Joe has a winning trade, you have a winning trade. When Joe has a losing trade, you have a losing trade. You can see early on here, the position sizing actually cost you a little bit more, a few $100s more than what Joe was doing. Joe was actually doing a little bit better for about the first 2 months, about 30 trades, 35 trades in, was when you started to overtake Joe. We had this little bit of a winning streak. And when Joe won, great, but when you won, because you used position sizing and you maximized your position, your earnings, and minimized your losses, you actually earned more money. And this is what position sizing does for you. It kind of gives you that ability to break away. And so here again, Joe turned $5,000 profit, which is great, but you could have done a little better. You could have actually added to that and picked up another $6,000 or $7,000 in profit. And you can play with this. You can do this all the time. Oh, here's another very realistic equity curve. So Joe wins a few, loses a few, starts with 10,000, finishes with 12. Again, very, very realistic. You can see early on the position sizing really benefited you. The drawdowns, even though you ended up getting back here even with Joe, the drawdowns really were not that crazy. And then again, when you start to win, you can see the profit really rallying. What you can do if you're playing with this is you can click on this chart and you can actually see how the trades worked out. So you can see Joe's actual net profit, 11,800. Using position sizing, you did about $5,500, or about $4,500 better. You did 16,200. Gross profit, gross losses, average winning trade, average losing trade. And then you can go through here and you can see, what I always found interesting is that these trades, there's no real home run trades in here. You're not going to find like $1,000 trades. Rather, they're your bread and butter trades. And here's one, $37.50, $75 profit, $350 profit. But look at what happens when you use position sizing. That $350 profit, based on your account size, you could have turned it into a $2,100 profit. And then, of course, you can play with the values as well. See what happens if you're only correct 40% of the time. And you can see position sizing here in this instance, you probably would have finished pretty much even with Joe. And you can just go through this. This time you were dead even with Joe's trades. Again, well, actually this is fairly realistic. 40% system, so you're losing more than you're winning. And this can happen. One of my most profitable months ever, I was only running about 40% on my trades. So this is very feasible. It is very doable. And you can see when you were winning, the position sizing helped you. When you were losing, the position sizing helped you as well mitigate the losses. So really something that you have to get a handle on is controlling your risk. And that's what that's all about. All right, enough on that little rant. But it's very important, and like I said, something most people never get a handle on. All right. right, so we keep drifting lower. Oh, we actually have a late filter entry here now on the Falcon. Late filter entry signal. Here, let me get this in, and then I will show it to you. The late filter entry signal develops when the filter goes out of sync, comes back into sync. However, the trend line itself never changes color. Where's the next resistance line? 6,800, that's going to be a big number for us again. So the next support line down here, 67.93. I may try that as a profit target. Yeah, I know. Here, David says I would put a buy above that last swing high, but not now that the low's been broken. It's addictive, isn't it? Counter trend trades, trying to get on the reverse. It's so enticing, and yet so difficult to do. There. Well, actually, maybe why don't we try to run this one out? It seems to be cooperating a little. Oop, I need to enable my stops. There we go. All right, so a little bit of a hiccup there. Just out of curiosity, would the parabolics still hold me in? Nope. So parabolics or the bar high-low strategy, regardless, I would have been tagged on that little bit of a hiccup. Uh, 6,800, again, a big number for the market yesterday, so no surprise. Yeah, David says that's been my downfall in the past. I would strongly encourage you to keep a handwritten trading journal. And what you want to do in that trading journal, you don't just want to document your entry and exit, but also the reasons you had for taking the trade. And I really need to update this photo, but let me show you a snapshot of my journal from years ago. So I just use a spiral notebook. You know, you pick them up for $1 or $2 at the Walmart or the dollar store. And I put the date. I put the time of the order. I don't even write buy or sell anymore. I just go S or B. E stands for Eagle, H was Hawk, F was Falcon. The instrument, my entry price, my stop loss. Excuse me. Now I also put down my profit target if I have it. How the trade worked out. So this was the 30-year bond, 343.75 loss. But here's the important part, the reason for taking the trade. So it was the first signal, it looked like a head and shoulders top. What was the result? I got in too early, no trend yet. So what I ended up doing after this is I actually started putting stars when I recognized what I did wrong. And here's the next trade was on the mini Dow, on the Hawk, first micro macro crossover. You're going to see you're going to develop your own shorthand. And this is how we actually developed a lot of the signals, our high probability signals, by journaling and finding out what was going on. So here I thought it was retracing, namely counter trend, resulted in a 290 loss. Crude oil was up. There's a kind of a direct relationship between crude and the mini Dow, but it did not stick this time. And what did I learn from that? Well, the market was in a downtrend. Here on the Falcon, see, this is how we came up with the second push entry idea that resulted in a $300 profit. And then a scalp on the Hawk, $100 profit, and another scalp on the mini Dow, another $100 profit, and so on. I very, very rarely review my trading journal. However, just the act of writing something down on a piece of paper, the physical act of writing it down, somehow embeds it in your memory. And you're going to find that as you write the same things over and over and over again, you're slowly going to clue in and say, oh yeah, I've seen this before. And you'll slowly start to recognize things that you're doing right and things that you are doing wrong. This is why I can tell you that one of the things that I do wrong, one of the things that cost me money are my counter trend attempts. And that's partly from journaling my trades. If I did not journal my trades that way, I would not know that. Great question here from Phil. Phil asking, does the price level difference between the support and resistance lines give an indication as to market volatility? Most definitely, Phil. The wider the line's space from day to day, the more volatile the market is. And of course, the narrower the lines tend to get from one day to the next, the less volatile the market is. So yeah, if you're comparing your support and resistance lines from the last few days, you'll get an idea whether what's happening to the market volatility. Another good tool for that is the day ranger. That's this little tool that sits up here on my Hawk. And it gives you your average 5, 10, and 30-day ranges. And you can see that based on the daily ranges, the market volatility seems to be contracting a little bit, doesn't it? Although yesterday the volatility was way up. Today, volatility half of what it was yesterday. And as a whole, the market volatility seems to be contracting. The 30-day range, around 570, around 420 for the 10, and around 370 for the 5-day average. So yeah, we definitely have some shifts in volatility, it seems. Good observation, though. Okay, another pull back. David says, my day ranger only shows a 5-day average. What you need to do is you need to make sure you have enough data loaded. So go here into your data series. It's not going to give you a 30-day average if you don't have at least 30 days loaded. Well, 31 days. right? If you only have 10 days of data or 5 days of data, that's all you're going to get. So throw more data in there. The problem with trading as well is that a lot of times we have a production line mentality and we feel like we have to be doing something. If we're not doing something, we're not making money. And as I have so aptly demonstrated, sometimes doing something has the exact opposite effect. Hazards of being a trading room moderator. At least when you make mistakes at home, nobody sees it. Yes, good observation here. David said here on the number 2 signal, where the reversal, a higher low and a higher high. And that's actually what the number 2 looks for, the number 2 signal. All right, let's put that away. Okay, a possible trend change developing here on the Eagle and the Raptor. We're turning over on the cloud. The Hawk and Falcon both already fairly bullish. David's asking what prevented you from taking the number 2 signal in this trade. I was probably pointing out the difference in the support and resistance lines to fill. I was probably answering a question. Just so everybody's clear, this isn't like your normal trading room. This isn't just a trade call room, right? My job, if you will, is to help you become more proficient with your trading tools. If I can point out a promising trade here and there to you, so much the better. But you'll notice that from time to time I go off on a little bit of an educational tangent. So questions are always welcome. All right, here we are in sideways mode again. The market is getting so restricted that, we could even do an OCO style order. We could look to enter here above that little high. We could short below here and just let the market settle the direction for us. So now that we're in, it's always a good idea to have a stop in play first before you do this. And we'll try to run this a little. $68.30. That's going to be that stumbling block again as we try to press higher. This is just a little bit of a late entry on this number one signal that we had print. 68.30, a very, very realistic target. If we can get above 68.30 this time, there's a good chance we could rally back here to the high of the morning and the median line at 68.40. That is a very real possibility, but first things first. Come on. So the trade manager just taking care of the stops for me right now. Come on. Wow. Just no love from the market here this morning. I'm going to hold my stops here. Now we're trying to resume the bigger downtrend again, so the market really stuck, constipated. Okay, come on, here we go. Here we go. Okay, here we go. We're going to take a run at 68.30. A couple of comments here. David asked, my thinking is that the longer it takes for a trade to develop, the less likely it is to be profitable. Yes and no. Ray Burke was always of the same mindset, but if you know Ray, he's very much a type A personality where, you know, when something happens, it's like, come on, let's go, let's get her done now. The length of time it takes for a trade to develop has almost nothing to do with the chance that the trade will be profitable. The market sometimes just needs some time. If the market is taking a long time to do something, it's because traders are very content with the prices that the market is trading at. It makes less sense with a stock index like the NASDAQ, but if you consider something like crude oil or soybeans, a lot of times there's no reason for these items to change prices, right? If traders believe that, where's crude oil trading right now? 68.20-ish is a fair price for crude oil. Well, guess what? That's going to be the price of crude oil. If they think it's undervalued, well, then it's going to go higher. If they think it's overvalued, it's going to go lower. But if they think it's a fair price, then it's just going to stay in that price range. Yeah, Scott says, how does the market know to go to my stop loss line? Oh, I've been there, Scott. When you get these slow gyrating markets, there is a lot of stop hunting that goes on. The market will, because it has nothing else going on, it'll drift. It'll go a little higher. It'll go a little lower. Traders will pull their orders on purpose just to watch the market come down. And they know their stop loss orders down here below 68.20. So they'll pull any buy orders. They'll let the market drift. And they'll capture some sell orders and then rally the market up and stop them out on the top side. See, here we are again at 68.30. Okay, Scott has a question here about the late filter entry signal that developed right here. I guess it was this one right here. Scott asks, on the late filter entry, the bar just to the right of the hash mark is red. Does that kind of lose the strength of the signal? No, it does not. The problem we're having today is the market really has no reason to go higher or lower. If you take a look, it'll be easiest to see here on the Eagle. If I project yesterday's trading range forward, so there's kind of the bottom end of the range. Here's sort of the top end. So this is yesterday's trading range. Oh, look at that. Look at where we're trading. So we really haven't moved too far out of yesterday's trading range. That's the problem. We are sideways. And that will have more to do with signals failing than anything. Okay, we got a little bit of an uptick above 68.30, not much. I may move here to a chandelier strategy. It's a very conservative strategy. I think I should probably look at placing a profit order as well. So it'll be a bit of a home run if I can get up here to 68.40 without getting tagged out first, that is. Scott asks, you think the follow through has not been real strong in a week or more? Yeah, I would agree. Here's the daily chart, and you get a real sense of the sidewaysness of the market. Look at how much overlap there is here compared to this here. See how the market was actually making progress? Very little overlap between the bars, and yet since the beginning of April, end of March, beginning of April, we have had nothing but overlap. We are going over the same prices time and again. Yesterday looked like an impressive bar, but really it too was a very slow sideways grind. All this rally came within the first hour or so of trading, and then after that, the rest of it from pretty much, well, today's bar was for the remainder of the session. So what's going on here is traders are looking at this and they're trying to get a handle on, is the market in a downtrend? If it is, then this is a bear flag and it's starting to wedge, in which case it's likely the market will break down again. That's how traders are viewing this. Now, if let's say tomorrow we had another rally bar similar to this one, again with very little overlap, then you would see all the sellers scrambling, because that would suggest the market is short-term bullish and we are going to retest the top end of this rather large trading range that we are in. If you haven't picked it up already, we are in a sideways trading range in the stock indices. So as we get into this top third, top quarter of the trading range, sellers are going to become more aggressive. As we get into the bottom third, bottom quarter, the buyers are going to pick it up. And this is likely to continue through the summer. If you think this is coming to an end, far from it. We are likely to see the market remain congested like this through most of the summer. And after that, then the $64,000 question is, oops, sorry, wrong button. Given what Wyckoff said about the way the market develops, is this sideways trading range, that's what we're in right now, sideways trading range, is that merely an accumulation phase, in which case the market will head higher? Or is it a distribution phase, in which case the market will head lower? That's the big question. Now, before you start to panic about your investments and such, oops, wrong button. Doggone it. See, I told you I can't multitask. Let's see if I can get the big picture here. No, not on this one. All right, bear with me here a second. Before you start to panic about your investments, yes, Scott said, stupid April. I know. I'm with you on that, Scott. stupid month. Oh, I guess I should enable my stops here, try to protect a little bit more of that profit. Sorry, my computer's doing double time here. Okay, what I mean to show you is before you start to worry about your investments, here is the NASDAQ on a yearly chart. And what's the trend? Well, since 2008, so for the last decade, the market has done nothing but trade higher. Yes, there have been corrections. Yes, the news people get all excited, but the market just keeps going up and up and up, and there's no reason to believe that it won't continue that way. So don't panic just yet. The big decline was back here in 2000 when the market had a very major 2-year correction. But after that, just no looking back. Good observation here from Nick. Nick writes, am I correct in comparing the ES to the NQ? The trading range started on March 30th. The ES broke above the range yesterday, but the NASDAQ hasn't. The market may go faster if the NASDAQ breaks out. Yeah, the stock indices, the big three, the ES, that's the E-mini, the NQ, the NASDAQ, and the YM, that's the mini Dow, tend to move better when they are in agreement with one another. When they are chopping about and one's heading higher, one's heading lower or not following, then yeah, they're kind of dragging their feet a bit. Likewise for the Russell. Now, a lot of people think the E-mini is actually the one to move first, but it's not. Usually, the NASDAQ and or the Dow move first. Here is the Russell. And just the Russell, look at the daily range here on the Russell. We finally broke above the high of today's trading range in the Russell. Just a very, very quiet, flat kind of day. And really not much else going on here right now. David says I would take profit here. I'm trying to get up here, nursing the trade along a little bit. We are definitely more bullish at this point. Let's see what my parabolics are doing. There we go. We'll go into parabolic mode. Yeah, I agree with Stephen. I don't care if it goes up or down. I just like the volatility. I don't like too much volatility, but certainly a little bit more volatility than what we're seeing here would be nice. All right. Well, that helped. me up a little bit. Got me back into the black. It would actually be a good day if I didn't pooch the earlier trade, but whatever. It happens when the market is like this. You just got to prepare yourself for it. You know what, folks? I'm just looking at the charts here. We've got so much sideways trading going on here. I'm not sure we're going to get another decent opportunity here this morning. Getting closer to the lunch hour break, which is going to make things a little bit more difficult again. All right, I think we're going to wrap things up here for the morning, and we'll take another stab at it tomorrow. If you are going to continue trading today, well, we're back near the top end of the trading range, so it would suggest the market's going to perhaps try to head lower. You can see here, there's the high of the morning, so we're kind of at the top end of the range. But the immediate trend is up. So grab a quarter, flip a coin, and see whether you should be a buyer or a seller. It's that kind of day right now. I think I'm going to go do something else and not risk ending up in the red today. Yeah, I don't know. It's tough. I would favor the bulls ever so slightly. But it's a tough day today. No two ways about it. All right, gang. I will see you tomorrow. We'll talk to you then. Bye for now.